Alright, welcome to the Japanese Candlesticks trading crash course. I have designed this course to take you from beginner level trader to a professional level trader in less than 4 hours. So I want to discuss here what are the things that we are going to cover in this course. So first we'll begin with the basic introduction. Remember, there are 35 videos in this course, 4 hours of video content, so there is a lot of work to be done here. So first we will look at some basic introduction, like who invented Japanese candlesticks, who popularized Japanese candlesticks and things like that. Second is we will look at who are the market players, what are the market views, what are the market sentiments, and what are the three kind of market positions. Then we will look at the anatomy of Japanese candlesticks, how they are actually constructed. Then we move to the different types of Japanese candles. We need to know that. Second is what are the major bullish and bearish engulfing patterns. I'm going to cover 2 bullish patterns and 2 bearish patterns here. Due to time constraints, I cannot cover all of them because that I have placed in the level 1 course, but I will try to cover the major ones, the most important ones here. Next, we will also look at how to practically use these patterns. Understanding patterns is not difficult, but how to use them is very important. So we need to know how to use these patterns conservatively, ultra conservatively, aggressively, and things like that. We will look at different styles of trading. Then we will go into the nuances of candlestick patterns. So just because a pattern looks like a particular candlestick pattern doesn't mean that we have to trade that pattern. So I will discuss this in more detail when we go into the course. Then we will go into 2 more bullish and bearish engulfing patterns. I can't cover these 2 in detail, but we will touch upon the surface just to give you an idea of how deep this knowledge can go into and why you should consider going for the level 1 course as well. Then we will go into the more advanced, because this is the first section. Then we'll go into the second section, which is the more advanced candlestick patterns, like the doji. What are the types of doji? There are almost 16 different types of doji. We will cover them in level 1 and level 2. Then you have the windows. I will talk about why windows are the best candlestick pattern, why they are my favorite candlestick pattern, why they are Steve Nissen's favorite candlestick pattern. Okay. Then we will look at stars, shadows, and real bodies, how to use stars to exit existing positions, things like that. So then we will look into how to take entry in a trade and how to exit a particular trade. The Japanese candlesticks allow us to precisely pinpoint our entry point and pinpoint our exit point. So this is very interesting section here. I want to cover this in this course. Then we will look at the most important concept, the secret of professional traders, which is the reward to risk ratio. If you understand this concept, you will make money in your trading. Okay, but it's not just important to understand the concept, it's also important to implement it properly, and we will discuss that in the course. Then we will go into how to avoid taking bad trades. Taking trades is easy. Okay, we can identify certain factors, but avoiding bad trades, that is where the psychological aspect comes in. How can we discipline ourselves to avoid trades which don't fit into our criteria? Okay, then we will go into round numbers, Bollinger Bands, Stochastic. These are some of the Western indicators which we have to combine with Eastern Japanese candlesticks techniques to generate powerful trade setups. Then we will do a summary, kind of covering everything in a nutshell, and then we will look at why you should go for level 1 and level 2 courses, which I have designed for you, which has advanced concepts. The same concepts are discussed in detail in this course. This is just 4 hours, still a lot of material, but I have just touched upon the surface of these concepts. We have to go in more detail, and because of the time constraints, I couldn't cover them here. So get ready for action. There is a lot of material to be covered here. Watch all the 35 videos in the same order that I have placed here. So all the best. I will see you on the inside. Take care and complete the course in the same order that I have given here, all 35 videos. Thank you so much. So welcome to the Japanese candlesticks trading crash course. In this course, I will take you from the beginner level to at least an intermediate level. You will understand the difference between the professional traders and amateur traders, how professional traders manage their risk and how they use candlestick patterns to make money in the markets, whether it is stock markets, commodities markets, or currency market. So let's have a quick introduction. This is just an intro video. I am Rohit and I am a CFA charter holder, and I am a founder and director of the Turtle Shells company. This is a financial education company, and we create educational resources like this to help you increase your success rate. And this is my official CFA badge. I am a Nissan certified advanced Japanese candlesticks charting expert. Now, if you want to learn Japanese candlesticks, the best trainer in the world to learn Japanese candlesticks is Steve Nissen, because he was the one who introduced Japanese candlesticks to the Western world, because Japanese candlesticks as a trading tool was more than 200 years old, and Steve Nissen was the one who researched it and got it to the Western world. So Steve Nissen is my coach. I am also a Dale Carnegie certified trainer. I founded a community in Dubai. I was in Dubai for 9 years, after which I came back to India. This is a financial education community, the Money Turtles community. And we went from 0 to 800 members in less than 1 year. So in this community, we used to meet, discuss about finance, personal finance, investments, assets, liabilities, debt, taxes. We used to play the cash flow game, and good community is still functioning in Dubai. I have also founded the Cash Flow Club of India. I am also into podcasting. I also have a YouTube channel. So a lot of things I am doing online. I used to work with First Abu Dhabi Bank, Union National Bank. I spent good 4 years with the Bank of Egypt when I was in Dubai. I started my career as a software developer. So that's a quick intro of mine. This was in Dubai, and Mr. Frederick Level, chairman of the board of governors of the CFA Institute, Mr. Paul Smith, CEO of CFA Institute at that time, and Mr. Amir Khan Saheb, the president of CFA Society in the Emirates. So this was back in Dubai. So that's a quick little intro of mine. Let's move ahead. This is Mr. Munehisa Homa. He was the one who originally invented Japanese candlesticks back in the 18th century. Sorry. So he is called the father of Japanese candlestick charts. There is a record in history which says that he had more than 66 consecutive profitable trades, something like that. I don't know whether that number is correct, but you can look up on the internet. He had that many consecutive trades, right? So he was the most successful price action trader in world history. And when he was 31, he wrote this book called as The Fountain of Gold, The Three Monkey Record of Money. This is the world's first book on market psychology. He was the first one who understood the importance of understanding psychology to make money in the markets. So he said that there is yin and yang in the markets. So sometimes the market is going up, sometimes the market is going down. So he was the best at analyzing price, and after he developed the Japanese candlesticks as a tool, it kind of evolved over a 200-year period. And in 1989, it was Steve Nissen, he is my coach. He got this knowledge, he researched it and got this knowledge to the Western world in 1989. So he is called the father of modern Japanese candlesticks charting. So whatever Japanese candlesticks techniques people are using now across the world, much of that credit goes to Steve Nissen, because he was the one who popularized Japanese candlesticks more than 30 years ago now. So he is the author of this book, Japanese Candlesticks Charting Techniques. Please buy that book. For me, that is like a trading Bible. Every professional trader has this book. So if you are serious about learning to trade, please get that book. It's available on Amazon. So Japanese Candlesticks Charting Techniques. I use it as a reference book now. I have read it more than 3 times. So I use that as a reference book. I have also taken more advanced educational resources from Steve Nissen. That is why I am a certified I am a Nissan certified advanced Japanese candlesticks expert. So you can do that. There is a website, I think it's candlecharts.com. You can go there and you can find a lot of resources by Steve Nissen there. And in my view, he is the world's best trainer in when it comes to Japanese candlesticks charting techniques. And this book has sold it's sold hundreds of thousands of copies all over the world. So get that book, it will help you. It has helped me, it will help you. So this is how a Japanese candlesticks chart looks like. So this is the price. This is a daily time frame chart. So each candle here represents 1 day's worth of price action. This is Nifty 50, which is a representation of top 50 stocks in India. So on the y-axis you have the level, index level. On the x-axis you have the timeline, and as you can see back in June, so this one, so back in June the market was at 12,000 level, and by the second week of August, let's say we come here, by the second week of August the market has gone below 11,000. So that is how you interpret this chart. If you have been trading for some time, this chart is very elementary and basic for you. It's very easy for you to understand this. But if you are someone who has never looked at a chart before, this might seem a lot of overwhelming. You might think, why is there these lines like this? Why is there not a straight line, something like this? Because the market moves in a zigzag position. Don't worry, we'll get to that. This is how a Japanese candlesticks chart looks like. Okay, so that's a quick little intro for now. We will start digging deeper. We will go into how does this candlestick gets created and how to analyze it, what do these different shapes and colors mean. So we will get into that. Okay, all right. So if you look at any market has basically two players, the bulls and the bears. The bulls are the one who push the market prices up, and the bears are the one who push the market prices down. So there is a constant battle that is going on between the market participants. Some people are trying to push the prices up and some people are trying to push the prices down, which is the reason why you have prices moving up and down in the market. Okay, so when we are looking at any chart, we need to understand who is more powerful in the market. Is it the bulls or is it the bears? So if the bulls are more powerful in the market, I will buy or I will take a long position. If the bears are more powerful in the market, I will sell or I will take a short position. Understand that as a professional trader, you should be able to make money irrespective of where the market is going. You can make money when the market is going up, you can make money when the market is going down. Normally, amateur traders only think that you can make money when the market is only going up. But professional traders, they make money both ways, and we will see how that happens as we go along. Okay. So now, because there are two market players, there are five market sentiments: the bullish, the bearish, the neutral to bullish, and the neutral to bearish. Now, bullish means what? So if I feel that the prices are likely to go up in the market, I am a bullish market participant. If I feel that the prices are going to crash or fall down, I am bearish on the market. If I feel that the market is going to remain flat, it will neither go up neither nor it will go down, I am neutral on this market. And if I feel that the market is less likely to go down, that means the market is either likely to go flat or it is either likely to go up. So that is called as neutral to bullish. In neutral to bullish, what I am saying is that chances are the market will either go flat or up, but there is very low probability that it will go down. Similarly, in neutral to bearish, there is a very low probability that the market will go down. I feel that the market will go flat or it will go down. So these are all market sentiments, these are all emotions in the market. So it's just a view. Okay, I can be bullish on the market, but when I buy, the market might start falling. So it's just a view, it's just an emotion, it's just psychology. Okay, So what do I do when I'm bullish? I take a long position. Now, as someone who wants to become a professional trader, I want you to understand that don't say I will buy or I will sell. As a professional trader, if you are bullish, you say that I will take a long position. As a professional trader, when you are bearish, you will say that I am taking a short position. Short position is a position which you can take when you are bearish on the market. So let's say you are bearish on the market and you take a short position. When the market goes down, you make profits. In a long position, when the market goes up, you make profits. Okay. So understand that as a professional trader, you can make money both ways, and you can check with your broker how to take a short position. He will guide you in that, in how to place a short position order. So short position is where you make money when the market goes down. Long position is where you make money when the market goes up. So that's the first lesson. If you are a very new or if you are a beginner in trading, you can make money both ways. Okay, for professional traders, it doesn't matter where the market is going. So that's the thing. Next, neutral. If you think that the market is going neutral, you take no position at all. You neither go long nor do you go short. Okay, you remain flat on the market. So when I say that I am flat on the market, which means I have not taken any position. When I say that I am long on this market, I have taken a long position and I expect the prices to go up. When I say that I am short on the market, I expect the prices to go down, and when the market goes down, I make money. Now, what if I am neutral to bullish? Now, this is good for people who are advanced traders, like people who are into options trading and things like that. So, this is good because I take, if when I am neutral to bullish, which means I will neither take, I will first, I may or may not take a position. Second is, if I take a position, I will take a long position because I feel that the market is less likely to go down. It will either go flat or it will go up. Okay. Same goes for neutral to bearish. So I will either don't take any position, or if I take a position, I will go short on the market. So that's the basic, it's very basic, these market positions. First, we have to decide our view, and depending on the view, we can choose to decide which position to take. And Japanese candlesticks help us to decide what is our view and what position we have to take exactly. Okay. Alright, so now let us have a look at the Japanese candlesticks anatomy. How exactly is the Japanese candlestick is created? Let's look at the basic structure. Okay. So on this chart, you will notice that there is a black candle, there is a white candle, and there is a candle which is very small like this. Okay, so there are basically there are three types of candles. One is the bull candle, then you have the bear candle, and then you have the doji candle. So on a bull candle, as we discussed before, the prices are going up. On the bear candle, the prices are going down, and on the doji candle, the market is flat because it doesn't have any color. Okay. Now what's happening on the bull candle? So let's consider this. This is a candle for a day. For example, let's say on Monday the market opens, let's say this is the opening price, let's say the market opens at 100. Okay, then during the day the bears push the prices down and push it till 80. So that's the lowest price for that day. And then the bulls, first the bears were pushing the price down from 100 to 80. Then the bulls come into the market, they start pushing the price up and take it to 150. Okay. And then by the time the day closes, the bears again push the price down and close it at 130. So these are approximate numbers. So what this candle is saying is that on that day, on Monday, the market opened at 100, closed at 130. However, the low of the day was 80 and the high of the day was 150. This is all there is. So this candle is just a summary of entire day's worth of price action. So A candle is nothing but a combination of open, high, low and close. And this rectangular portion is called as the real body. The distance between high and the close for a bull candle is called as the upper shadow. This is also called upper wick, and this is the lower wick or the lower shadow, the distance between open and the low. Okay. Understand that there is heavy market activity at opening and closing. So when the market opens, there are a lot of people who want to get into the market, so they want to buy. And at the same time, there are a lot of market participants who want to immediately get out of the market once the market opens, because maybe they want to book profits or maybe they see opportunity somewhere else. On the closing also, there are some market participants who are saying that before the market closes, I want to get out of the market. And there are other participants saying that before the market closes, I want to get into the market. So there is a lot of market activity at open and close. So that's the bull candle for you. Now this is, we discussed for a daily candle. Okay. This can be a weekly candle, this can be a monthly candle, this can be a 1 hour candle, a 10-minute candle, 15-minute candle, 1-minute candle, 4-hour candle. It can be any time frame that you choose. Depending on the time frame you choose, the shape of the entire chart will be different, because you are changing the time frame of that candle. But understand that whatever candlesticks knowledge or patterns we are going to be discussing are applicable to all time frames. Okay, so that is the concept of universality, where candlesticks are so universal, they can be used on any asset class, stocks, commodities, currencies. They are also universal in a sense that they can be used on any time frame, from monthly going down till 1 minute chart. You can use the candlesticks. Moreover, candlesticks are also universal in a sense that you can use them on any instrument. Like if you want to trade cash market, you can use candlesticks. If you want to trade futures, you do candlesticks. If you want to trade options, even there candlesticks are going to be helpful for you. So that's the bull candle. It's very easy. It's just open, high, low and close. Okay. The rectangular portion is the real body. Then you have the upper shadow and you have the lower shadow. Understand that the lower shadow represents bullishness and the upper shadow represents bearishness. Because for the upper shadow, the bears have been successful in pushing the price down. On the lower shadow, the bulls have been successful in pushing the price up. So the lower shadow is created by the bulls and the upper shadow is created by the bears. Okay. And the real body is where the real price action is happening, because it represents market opening and closing. I like the daily charts because it represents official opening and official closing. Like for example, a 15-minute chart, these are not official opening and closing prices. It can be somewhere during the day. But for opening and close for a daily time frame chart, that is the price that gets circulated in the media. That's the official opening and closing. Okay. So for a bear candle, there is nothing different. We have the real body, the upper shadow, the lower shadow. Only thing is that the opening and closing have flipped their positions. So the market opens at 130, goes to 150, goes down till 80 and then closes at 100. Okay. That's the only difference. That is why the color is different here. It's just that the opening and closing have flipped positions. Just understand that when you have a bear candle, the market prices are going down. Doji candle, as it's very obvious, it doesn't have any real body. It has long upper and lower shadows in this case. Now the opening and closing obviously are the same in this case. So that is why we say that the market is flat, or the market is confused, or the bulls and the bears are in equilibrium, or the power of the bulls is equal to the power of the bears. Now you look at this chart, now you will be able to understand how the prices have gone down. If you look at this downfall, you see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, around 11 black candles, and how many white candles? 1, 2, 3, 4, So you have 4 white candles and 11 black candles. That is probably the reason why the prices are going down. This is a very strong bullish candle. This is a very strong bearish candle. And also notice that within the white candle there are different shapes. So this white candle is very different from this white candle, or this black candle is very different from this black candle. So depending on the shapes of the candles, you can have multiple permutation combinations of different patterns, which is what Japanese candlesticks patterns is all about. So you can have multiple shapes of shadows, you can have multiple lengths of shadows and bodies. So depending on these lengths and shapes, we can have, or we can identify different patterns in the market, and which will give us more insights into the market. Okay. Right, let's have a look at a bullish pattern now. So bullish patterns are the reversal patterns in Japanese candlesticks. So if I am bullish on the market, which means I want to buy in the market. So reversal pattern, understand that reversal pattern does not mean that the prior downtrend is going to completely reverse, or the prices will go from down to up immediately. Reversal simply means that if there is a downtrend in the market, or if the prices are coming down, then reversal pattern shows us that, tells us that either the price will go flat or it will go up completely. The reversal pattern doesn't mean that the trend is immediately going to reverse, and we will look at this with examples so that you will be able to understand. But just for now, just understand that reversal doesn't mean that the trend will go from down to up or up to down. Okay, reversal means that the prior trend is likely to end. Okay, so have a look at this pattern. Okay, this is a bull candle. Now the distance between the high and the low is called as the trading range. Any candle you take, whether it is doji candle or a bull candle or a bear candle, the distance between the high and the low is called as the trading range. So now let's analyze this candlestick pattern, and why is it important to why is it important for us during our trading. So it's a single candle bullish pattern. So it's just one candle and it's a bullish pattern, which means that after I see this pattern, I am likely to take a long position, okay, as a professional trader. Lower shadow must be at least twice the height of the real body. So this is the criteria of the hammer. This candle is called as a hammer because it looks like a hammer. Okay. And remember one note here, side note, that candlestick patterns are proven, tested, documented, and this science is more than 200 years old. So these patterns which we are discussing here are already tested patterns, so there is no subjectivity in this. So all of these rules are very rigid. You have to follow these rules. Unless these rules are met, you cannot call this as a hammer. Okay, so strictly follow these rules. So lower shadow must be at least twice the height of the real body. So the lower shadow, so the distance between the open and the low. So this is the lower shadow. This distance, let's call it A, and this distance, the height of the real body. So that's the real body, that's the upper shadow, that's the lower shadow. So let's call this B. So what this point is saying is that A should be at least twice of B. Okay, if it is more than twice of B, it is even better. Okay, so here just by eyeballing it, we can tell that the lower shadow is more than twice the height of the real body. It must come after a downtrend. So if the hammer is coming after an uptrend, it is that if you see this candle after an uptrend, it is not a hammer. When you see this candle after a downtrend, only then we can call it as a hammer. Otherwise we cannot call it as a hammer. Okay, next, it should preferably have no or very small upper shadow. So this upper shadow that you see here, it should preferably be small, or if there is no upper shadow, it's even better, because Remember I mentioned that upper shadow represents bearishness and lower shadow represents bullishness. So, and this is a bullish pattern. So we don't want any bearishness in a bullish pattern. So that is why this upper shadow, it should be as small as possible. The color of the real body does not matter. So if this color is white or black, it really doesn't matter. It's just that the real body should be near the upper end of the trading range. Trading range is the distance between the high and the low. So the real body, even if it is white or black, doesn't matter. It should be near the upper end of the trading range. If this body is somewhere here, then that is not a hammer. Okay. The real body must be as small as possible. So the smaller the real body, the better. Okay. Because if the real body is small, then the lower shadow is likely to be large in comparison to the height of the real body, which is what we want from this point. And the low of the hammer becomes support. So this is where the bulls have pushed the price up. So the low of the hammer becomes our support area. Support area simply means that the bulls are not allowing the price to go below that level. And resistance simply means that if there is a resistance here, the bears will not allow the price to go above that level. So the resistance simply means like a ceiling of a room, and the support means that it's the floor of the room. Okay. So to quickly summarize, what is the hammer? It comes after a downtrend. It has a small real body near the upper end of the trading range. The lower shadow must be at least twice the height of the real body. The real body should be as small as possible, and the upper shadow must be as small as possible. The lower shadow must be as long as possible. That's the only criteria. It's very basic. Just by looking at this, you will know that it's a hammer. Okay, let's quickly have a look at an example, and this will tell you how powerful these candlestick patterns are. So number one, see, this is a daily chart of Asian Paints. So each candle represents price action for a day. Okay, that is one thing. This is a chart of Asian Paints stock. The x-axis is the timeline and the y-axis is the price of that stock. This is an example of a hammer. So the blue arrow is showing you that the price is coming down. Okay, so the price has gone from 1000 to near 850 now. Okay, you see the price has been 1000 here and now it is at 850. Okay, and we are somewhere in the third week of December. This is where December is starting. So you have a pattern here. This is called as the hammer. Because it looks like a hammer, it satisfies all the conditions of a hammer. You can go back and see the conditions in this video, but this satisfies all the conditions of the hammer. So if I buy here, I will have to buy at the closing point of this candle. So the closing price of this candle is this here. Okay, every candle has an open, high, low and close. So that's the closing price. So that's where I will buy or I will take a long position. The low is where the bulls have pushed the price up. So the low will be my support. So I will keep my stop loss below this, the low of this candle. So the stop loss is nothing but a way of protecting my position, because if the price goes below this low, that means I don't want to be in that trade if the price starts to go below that point, because what I am saying is that this is a single candle bullish pattern. Okay, so I don't want my losses to multiply. So this is a way that Japanese candlesticks allow us to cut our losses short. So I told you before that the Japanese candlesticks are very precise in terms of giving us the market entry exit levels. So now I have a clearly established entry point. I also have the stop loss. This is my exit point if the price goes against me, and then I can expect the prices to go up. Now if you see how aggressively the price has gone up here, just a single Japanese candlestick forecasts this huge rise in prices. The price has gone from 850 back again to more than 1000. So understand that simple patterns like this, which even school kids can identify, are so powerful in forecasting price movements in the future. So now the hammer doesn't necessarily mean that the prices will go up. The prices could easily have gone sideways In this case it has gone straight up, but the reversal pattern that the hammer is just showing us, is just telling us that the prior trend, the downtrend is likely to end, which is what happened here. And the chances of the prices going down are very low because the bulls have already pushed the price from the low of the hammer. Okay. Another point to mention here is that my coach Steve Nissen says that candlesticks are a tool, not a trading system. They don't give us a price target. So for that we have to rely on Western technicals, which we will discuss later. How to put price targets, I will discuss that. But just understand that this single candlestick, which is as simple as the hammer, is able to forecast such a huge rise in price. That is the power of Japanese candlesticks. Okay.